Just a few more days before the American elections. Your investments will be safe if you just don't make these 4 mistakes. What's up everyone? My name is Joris. 2020 has been quite the year for the stock market. The VIX index or volatility index has been working overtime and it's about to get worse. The global news loves to report the dips in the market because fear sells. If your investment strategy is sound, however, you have nothing to worry about. Sit back, relax, and don't make any big mistakes in the next few weeks. But first, I will ask you to destroy the like button for the YouTube algorithm and to subscribe to the channel if you've not done that already. Also, hit the notification bell. 60% of you are not subscribed. What are you waiting for? It's easy, it's free, you can always unsubscribe later, and you will be notified as soon as a new video is uploaded. Election years. They always have proven to be quite volatile. Investors often expect one of the candidates to win, and they will allocate their portfolio towards that candidate. But opinions change quickly when the debates and polls are held. You, as an investor, should just disregard all this panic. Mistake number 1. Do not put your faith in one or the other candidate. As valid as his or her point of view might seem, in the long term, for the long-time investor, it won't matter much which one of the candidates wins the election. Capital Group economist Daryl Spence says that presidents get far too much credit and far too much blame for the health of the US economy and the state of the financial markets. He says that there are many other variables that determine economic growth and market returns, and frankly, presidents have very little influence over them. Since 1932, exactly 7 Democrats as well as 7 Republicans took office, and the markets have always ended on a higher point than when the elected president started at the start of his term. If you would have invested $1,000 in 1932, your investment would now be worth over $14 million. So don't just place your bets on one or the other candidate, just ride out the waves. As is custom, the elections have a clear winner and a clear loser. But you, as an investor, are the real winner every time if you just sweat out the volatility and you have to stay invested. This brings us to mistake number 2. As you have seen, the last few months, the VIX index or volatility index has been extremely high. Investors are uncertain what the future will bring. And this is bad news for the markets. The global pandemic surely causes some uncertainty, but the American president election is also causing a lot of stress on the markets. During the primaries, when a lot of candidates are put forward on both camps, there is no way of knowing which candidate will be running for president at the end. All their different opinions and goals of the candidates will have great impact on this uncertainty. But once the primaries are over and there are only 2 candidates left, volatility often lowers and the markets continue their trend upwards. You could use the uncertainty of the primaries to your advantage. When potential candidates are making their statements, they often target specific industries, putting pressure on them and on their market value. This offers investors an opportunity to pick up companies or industries that have had it bad during the primaries. More often than not, the candidates will say that they will target those industries, but once the primaries are over and they are not running for president, these industries often recover well. Investing in this totally contrarian manner is not an easy thing to do, and you will have to be able to cope with high volatile markets. Mistake number 3. Don't try to time the markets. Benjamin Graham once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." So he was basically confirming that time in the market will always beat timing the market. When presidential candidates are competing for the much desired place in the White House, they will address all problems that are currently in the country, in the United States, and their campaigns will amplify those negative messages. As a result, investors can also become quite negative, which will result in their view on the markets and their money. History shows that investors often seek refuge in money markets the year before and the year of the elections. They wait until the certainty of the new president is known to start investing again on January 1st on the next year after the elections. But as we have seen countless times before, time in the market will always beat timing the market. Don't fall for this known trap and just stay in the markets during the election years. And maybe just turn off your TV when you're feeling anxious. So what is the best way to invest in election years? Well, let's look at 3 example investors and look at the numbers of the last 22 election cycles since 1932. The first investor invests his $10,000 on January 1st of the election year, so 10 months before the actual election. This is the buy and hold strategy, obviously. Investor number 2 invests his $10,000 over time, investing $1,000 every month for the first 10 months of the election year, leaving the rest of the money that is not yet invested in a money fund. This investor is spreading his risk using the dollar cost averaging method. Investor number 3 is very careful. He stays fully invested in the money funds and will only invest his $10,000 on January the 1st, the year after the elections. So he is invested exactly 1 year after investor number 1. Number 3 tries to time the market. If these 3 investors stay invested for the whole 4 years, the result will actually surprise you. Well, actually it shouldn't really surprise you. In 14 out of 22 cycles, the buy and hold strategy will have the best returns over the 4 years of the election cycle, and only 6 out of 22 times the worst. The consistent contribution take home the medal for 5 out of 22 cycles, and they will never have the worst performing returns. The loser in this case is the investor that tries to time the market. Only 3 times out of 22 he will beat the others. And in 16 out of 22 cycles his return will be the worst. Furthermore, his average return of the all 22 cycles is almost $1,000 worse than the buy and hold strategy. So you see, don't make the mistake to try and time the market, just stay invested in the market. A fourth and final mistake you can make in the coming weeks and months is to watch the news too much. Bad news sells, whereas good news is boring and it does not sell. No one wants to hear good news. So you'll find way more articles stating the economy is bad and stocks will crash, more than that the economy will recover again and stocks will gain track. If you constantly watch the news, you'll keep worrying and even panic when seeing all the bad news. This is often a trigger of a sell-off of your portfolio. The smart investor knows how to ignore the major news and focuses on his investment strategy and his investment portfolio for the long run. If you have spent time picking out your current stocks and your ETFs with a long investment horizon, just turn off the news and let your invested money work for you. In the future, you will be very happy you've just forgotten your investment portfolio and it will have grown a lot by then. Now, what is your long-term plan in investing? Are you sitting back relaxed, not worrying about all the news, or are you still worrying about all the bad news coming out every day? If you've enjoyed this video, be sure to leave a like and subscribe to the channel if you've not done that already. It helps us a lot to grow, and I thank you for watching, and I will see you in the next one.